Hi, this is Tom Hoff from ProTech Valuation Services, bringing you this month's home value forecast. Now, early in March, the Federal Reserve increased interest rates by 0.25%. It was only the third increase since the housing crisis. Now, mortgage rates are forecasted to go up over the next 5 years from today's 4% to around 5.25%. But these are still historically low compared to the high teens during the late 80s. So during this time of historic low interest rates, we've been reporting about home prices hitting all-time highs in communities such as San Francisco, Nashville, and Raleigh. If we look at the Collateral Analytics home price forecast for these three metros, you can see that sales price appreciation, which has been on a steady increase since 2012, is forecasted to taper off and slow down. In fact, San Francisco is already forecasted to experience a slight dip before rebounding again due to the recent rate hikes. So we at Home Value Forecast wondered, what would happen if rates go up more than expected? Could we see a slowdown or perhaps a reduction in home prices if it costs more to borrow money? So the simple answer is yes. We ran the home price forecast again, keeping household income and employment forecasts the same as they were in the beginning, but for all three metros we did scenarios at 10% or 25% increases in the forecasted mortgage interest rates. As can be seen in the graphs, the model predicts that each metro would experience similar but different home price reductions if rates rose more than anticipated. Now, San Francisco, because of its already high cost of housing and lower affordability, would feel more of an impact from a rate hike than the other two metros, with prices dropping over 10% from forecasts versus less than half that, between 3 and 4% for Nashville and Raleigh. So why would San Francisco drop more? The answer is affordability. We use an affordability index, which is derived by looking at the median income for a particular area as a ratio to the mortgage payment needed to purchase a median-priced home. An index score above 100 signifies that a household earning the median income has more than enough income to afford the mortgage. Lower scores suggest more income is needed and used to cover mortgage expenses. So looking at the three metros, Nashville and Raleigh have similar affordability scores. They're both in the 170s. San Francisco, on the other hand, its affordability score is a 59. So San Francisco's low affordability score indicates that residents are putting much more of their income towards housing, which means that the market is much more sensitive to interest rate changes and could see the biggest impact on prices if there's an aggressive hike in rates. So to read the entire home value forecast, please visit protechservices.com. There you can read the entire post, including our top and bottom 10 metros for this month. Thanks for listening. Take care.